Mullen Automotive is back in the news, and once again, the story isn't pretty. The company's share price has fallen below 20 cents, continuing a painful and predictable decline that's become all too familiar to long-term holders. This time, the drop comes just weeks after Mullen executed yet another reverse stock split, a 1-for-100 consolidation that took effect on April 11th. At the time, the goal was clear: get the stock price above $1 and regain compliance with Nasdaq's minimum bid requirement. It worked, for a moment. But within just a few weeks, MULN fell right back below the $1 threshold, making this the fastest post-reverse split collapse in the company's history. And unfortunately for investors, that's just one part of a much larger problem. Mullen is now facing a second and arguably more serious delisting risk, this time not based on its share price, but on its overall market capitalization. According to Nasdaq rules, companies must maintain a market value of listed securities, or MVLS, of at least $35 million. On February 25, 2025, Mullen received an official notice from Nasdaq stating that it had been under that threshold for 30 consecutive business days, triggering a warning. The company was granted a 180-day compliance window, giving it until August 25, 2025, to fix the issue. But here's the catch: to regain compliance, Mullen doesn't just need to pop its market cap above $35 million for a day or two. It needs to sustain that level for a full 10 consecutive business days, and right now, it's not even close. At one point, Mullen's market cap dipped as low as $104,000, which is practically unheard of for a Nasdaq-listed company. Recent estimates put it somewhere between $13 to $15 million, still less than half of what's required. This isn't a minor shortfall, it's a glaring red flag that the company is skating on the edge of delisting yet again. Despite these mounting threats, Mullen has been trying to signal some positive momentum. There have been a few operational headlines over the past few weeks that, on paper, show movement. For example, the company's subsidiary, Mullen Motors, completed a delivery of its B4 Class 4 electric truck to the Lower East Side Ecology Center in New York City. That was a real delivery, not a prototype or a test unit, and for Mullen, that's meaningful. The company also announced a $1.4 million order for 20 Mullen 3 Class 3 trucks from a logistics provider called Cashflow on Wheels. These vehicles are reportedly being deployed on FedEx routes in Texas and Georgia, a sign that at least some portion of Mullen's commercial EV plans are being realized. From a financial standpoint, Mullen recently posted record GAAP revenue of $3.18 million for the quarter ending March 31st. That's not enough to turn the company profitable, but it does represent the highest top-line figure the company has reported so far, a small milestone in a sea of setbacks. To stretch its remaining cash, Mullen has also implemented internal cost-cutting measures, including staff reductions and facility consolidation. These efforts are intended to reduce the company's burn rate as it scrambles to preserve capital in an increasingly unforgiving market. And then there's the legal front. Mullen's lawsuit alleging stock price manipulation via high-frequency trading tactics has cleared an early hurdle, with a judge allowing the case to proceed to the discovery phase. It's a potential PR win, and one that may offer a bit of narrative support, but legal victories, even if they come, won't reverse the shareholder dilution or bring the stock price back above $1. And that dilution is still the biggest anchor around Mullen's neck. Over the past year, Mullen has issued hundreds of millions of new shares through conversions, warrants, and financing deals. Each time the stock is consolidated through a reverse split, new shares find their way back into the float, pressuring the price and eroding investor value. It's a vicious cycle, and so far, there's no sign that management plans to stop repeating it. With the stock once again below $1 and the market cap still deep in non-compliance territory, many investors are now bracing for the possibility of yet another reverse stock split, a move that could be executed before the August deadline in a last-ditch effort to keep the company listed. But after this most recent collapse, even that tactic is starting to lose credibility. Retail investors have been through this cycle with Mullen multiple times. A reverse split is announced, the stock briefly pops, confidence is pitched, and then, like clockwork, the share price crashes, often even lower than before. And the latest crash confirms that the market has stopped buying into the charade. The truth is, Mullen is running out of time, out of options, and increasingly, out of retail believers. Even though deliveries are happening and revenue is trickling in, the pace of progress isn't fast enough to catch up with the debt, the dilution, and the delisting threats. Unless the company can land a game-changing partnership, secure major institutional funding, or drastically ramp up its production and delivery volume, it's hard to see how Mullen can reverse course. The fundamentals are too weak, the compliance deadlines are too close, and the investor trust that once carried this stock through speculative waves is now hanging by a thread. For some, this is still a lottery ticket, a chance to make a big score if Mullen manages to pull off a miracle. But for others, especially those who've held through multiple reverse splits, the chart doesn't look like opportunity anymore. It looks like attrition. Thanks for watching. If you appreciate this kind of no-nonsense stock breakdown, grounded in facts, not hype, make sure to like, comment, and subscribe. I want to hear your thoughts. Is there any hope left for Mullen, or is this the beginning of the end? One thing's for sure, by August 25th, we'll have our answer.